Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Indeed, indeed, indeed it will be. Well, it's nearly the end of June. Can you believe it? I know everybody who's been going in for the 12 Js are getting their final little documents together. Interestingly enough, the 12J companies that are our partners in all of this say that they will still accept deposits until tomorrow, the actual close-off day. But my feeling is if you haven't done your 12J work yet, you're going to be quite struggling to get it all done. But this is our long-term portfolio. It's almost 7 years that it's been going for. I was doing the numbers today, working out the exponential growth. It is now 6 years and 7 months since we started the portfolio. Fantastic compound annual growth rate. And every time we sold an exponential stock, it's well put, exponential stock, I have had a shock afterwards because the damn thing has kept on going up. So we've learned our lesson. We won't be doing that again. My colleague Stuart Lohman, as always, is with me in our virtual studio, although he's actually at the, you're the only one at the office today, Stuart?
Yes, Alec, only one in the BizNews team here. Obviously Gavin and Callum are around, running around, but very quiet. I think the level 4 it's a real thing.
No, it's a real thing. And I think you're just about the only one who never got COVID out of our bunch.
Yeah, the two of us. It's a small percentage, I think, what, 20% if you look at the total number of the office.
Of the Joburg office, yeah. Anyway, well, the third wave is, I want to talk a bit about the third wave because it affected one of our portfolio, Discovery, quite badly in this past month. But Stu, do you want to take us through all the technical details?
Excellent, thanks, Alec. Those new to the webinar, there is a little high-five button on the control panel on the right-hand side. If you can see Alec and myself and hear my voice loud and clear and see a little presentation underneath our cameras, can you give us a high five? Oh, lovely stuff. Excellent, Alec. That all looks good. We do like to keep it conversational. In that same box, a little question mark, if you just open that drop down, you put your question in there and I'll pass it on to Alec as he runs through the interesting session we're about to have. Alec?
Indeed, and Stu does interrupt me from time to time because I kind of get into my stride, which is not always the best way of communicating. But anyway, here we are, and away we go. So today is just about the end of June, and here is what the portfolio did in the last month. It actually had a pretty good month. We had a really good April, you might remember. And then May, things came back a little, which was expected after you have shoot the lights out in 1 month. And then we've now had a very good June again, not quite back at April's levels, but not far away. The portfolio, and this is the interesting thing, you go and look right at the bottom there. This portfolio was started in December 2014 with $200,000. Now, what is interesting, as you saw from the first page, our return in US dollars has been just over 20%. And yet that has taken those $200,000 in a period of 6.5 years to $740,000. It's mind-blowing what this eighth wonder of the world, compound interest or compound returns, can do if you just keep compounding at a figure of 20%. Doesn't sound like much, does it? But Warren Buffett has done that over nearly 60 years now. He's achieved 20%, slightly higher than 20% compounded growth. And the reason for that is that you're starting to make money on money. So year one, you make a 20% return, you suddenly got 20% extra in your portfolio, which if that grows at 20%, it puts money on money and so on. So the eighth wonder of the world, this thing called compound interest. Having a look at the top of it, oh, incidentally, the rand, you can see the rand has gone from around 200,000 rand, I think it was, sorry, 2 million rand, 2.2 million rand is where we started 6 years ago, and it's now nearly 10.6 million rand. And in the past month, up very nicely by, sure, more than 500,000 rand. Incredible once you get this compounded effect actually working for you. But looking at the individual participants in the portfolio, I really blew it 3 months ago when saying, you know, Tonguat was really cheap, so let's buy into Tonguat. And purple, well, who knows, at, you know, 1 Rand 20 odd, maybe we should be spreading our investment into purple. Now, for those of you who've been following the portfolio for a long time, you will know that the way that we buy shares internationally is that we try to take out the impact of the South African rand, and as a consequence, we would buy the shares over a 3-month period. Well and good. When we already have a stock in the portfolio that we want to add to, usually we just add to that stock immediately. Well and good. But what happened here was that there were 2 shares that actually jumped out at us as offering great value. The one was Purple Capital, the other one was Tonguat. And of course, as Murphy's Law would have it, we bought Purple Capital over 3 months and we bought Tonguat immediately. Well, had we done it differently, as you can see, Tonguat has been a really awful stock in the last 3 months. It lost another 11% this month. Still lots of uncertainty there about the debt being refinanced by the banks. I still think I'm very comfortable that the homework has been properly done and that the underlying assets are worth a significant premium to what Tonguat's trading at. Also, I know I'm a little out on a limb here, especially with many people who have a very dim view of Zimbabwe, but to me, Zimbabwe does seem to be coming right. Certainly, it's moving in the right direction. And a big chunk of Tonguat's assets are in Zimbabwe, which have been written off to nil. It also, through the accounting processes in Zimbabwe, so I'm just switching off my camera so you can concentrate better on the screen, I'm sure. On the accounting processes, then hyperinflation, that also affects the financials as well. So, but as we look at it now, Tonguat, wow, we could have bought that over 3 months and had a much lower entry rate. And of course, Purple, had we bought that immediately, we would have a much lower purchase situation. However, some of that has been made up for by Spotify. I'll take you through some of the details there in a moment. Nice to see that 2U has lifted its head up. It's one of our underperformers in the portfolio. And then the rest of them, the exponential stocks, Microsoft, Amazon, Apple, Xero, Netflix, all had 6% gains in the past month, which is pretty good, showing Naspers. Those of you who've been following this portfolio for a long time will know that I've been scratching my head over Naspers because of the way that Beijing is attacking the main internet companies. But the problem that you always have with Naspers is it trades at a 50% discount, plus now more than 50% discount to just the 10-cent share. And if Naspers board were to change in its approach, and the pressure is building, I'll tell you a bit more about that in a moment, then the share price would just catapult. You're probably 30 to 40%. So do you sell Naspers and miss out on that 30 to 40%, or do you hold on the understanding that the board of directors will one day see the light and things will change? Well, as things happened today, we had news, a statement coming out from 91, whose founder and chief executive, Hendrik de Tooy, is the lead independent director on the Naspers board, and his company, 91, has come out and said that the deal that Naspers is proposing is a bad deal. So I don't know where that puts Hendrik in the next board meeting when he is discussing issues with the other members of the Naspers board. But what it does say is that the team at 91 are like other asset managers, and they say, enough already. Let's start unlocking value, please. Whether or not that's going to get Bob van Dijk to change his mind, it's certainly the interview that I had with him after the financial results came out, which should have been a welcome news for the company. He's still sticking to his guns that swap between Naspers and Prosus is going ahead. The asset managers don't like it. The market doesn't like it. And at some point in time, I guess something's got to give one way or the other. The other issue that happened here, and really that's the headline, is Discovery. Discovery down nearly 20% in the month. I love Discovery as a company, not just for what they're doing in South Africa, but globally, they are a very, very potent force now. And this is perhaps for those who missed out on buying into Discovery, this is a really good buying opportunity at 123 Rand a share. Anyway, those are the stories. Just to remind you that you can pose your questions. As Stu says, there is a little question mark there. I see there are a few already. Stu, before we go through, I hate doing that, being stuck to a formulaic thing. So Stu, you just jump in whenever you do want a question.
Thanks. Let me jump in because I know before we came on air, we were talking about hard marks and what do you say? You always kick yourself when you sell an exponential stock. You've just got two questions from Les and Steve to ask, would you go back into Facebook, and your thoughts on Cloudflare?
Yeah, both of those kick myself. First of all, with Facebook, you recall the reason why we sold out of Facebook all that time ago was because of Cambridge Analytica. It was pretty clear that Facebook's was misbehaving. And again, the reason why I've never wanted to go back into it is that the Democratic Party is really on the warpath as far as antitrust is concerned. Now, the difference between the antitrust movement in China and the antitrust movement in the United States is something that we should always pay attention to. In the United States, you're protected by law against politicians. In China, you're not. So in China, the attacks that are going on now against the internet companies are going to be pushed through. They're not going to change. The internet companies are going to be knocked on antitrust basis by Beijing. That's it. In the United States, not such a story. And we had a piece in the Wall Street Journal this morning, which I sent out, in fact, the link in today's newsletter, to say that Facebook has just won the first court challenge of 46 states that the Democrats were trying to attack Facebook on antitrust. They won that court case 6-love. It was dismissed, kicked out of court. So that's the story there. So, but would I be investing in Facebook? There's a fundamental issue on that model. And the model is they have made an enormous amount of money by abusing the privacy of those who use it. At some point in time, that model has to break, or you have to bring in somebody else has to come in and perhaps usurp the gorilla in that particular gorilla game. So no, I wouldn't buy Facebook. It's one of those companies. Fundamentally, I understand from where I'm sitting anyway, the media industry, and long term, it just doesn't fill me with great enthusiasm. When it comes to Cloudflare, I don't know what to say. Cloudflare was a stock that we bought in the 20s. We had a wonderful run in that company up to 60, 70. At the time, you might recall that there was quite a lot of concern about the emerging tech stocks actually coming under a lot of pressure. I love the Cloudflare story. I think it is just one of the most fantastic businesses in the world. But even amazing businesses that dominate their market, and in this case, it's internet security, there has to be a price at which they are fully valued. And I thought it was in the 60s. Well, it's now over $100 a share. Stuart was smart enough not to listen when we sold that stock, because the idea was that we would sell it to lighten a little bit on the emerging tech stocks and then reinvest into areas which were a bit safer. And he's happy. He's looking at it at $100 a share, whereas we sold it out at in the 60s. Would I buy back into Cloudflare? Of course. The problem there is, when are you going to get decent value again as a long-term purchase on that share? And it's a little bit like what happened during the crack in the market in March. I jumped into Cloudflare for the portfolio. because I'd done my homework and I realized in the 20s anyway, certainly in my thoughts, it was ridiculously cheap, and it turned out to be. And I think that's really what investing is all about. Do your homework. Don't be impatient. Wait, because Mr. Market will have one of his hissy fits or some kind of a tantrum, and you will get the opportunity. But I don't have it in the portfolio anymore, and it saddens me greatly. That's about all I can say on that one.
Thanks, Alec. I know you touched on Naspers early on. There's just a few questions on the share swap. Paul, Pete, and Mark want to know what you are going to do with the share swap. For process shares, obviously.
Yeah,
you're going to
we're swapping. And to me, I know the asset managers don't like it. I know that they think it's just another little nudge in the wrong direction. In other words, rather take Tencent, put it out separately, list it separately, let everybody get full value. Whether remember, because of the voting structure that they have at Naspers stroke process, and because Koos Bekker for decades didn't take a salary and just took shares, N shares, which are high voting shares, the control of that company doesn't lie in the hands of shareholders. It lies in the hands of in the hands of majority of shareholders. Koos Bekker controls it effectively, and as ridiculous as that sounds, because the size of it, but that's what people bought into. When you bought your Naspers shares in the first place, you realized that there are high voting shares, and those who own the high voting shares through various structures, they make the rules. So this battle of wills that's going on at the moment between asset managers who are minority shareholders when it comes to voting rights, but perhaps majority shareholders in the economic rights, are going to they have to convince Koos Bekker at some point in time to change his mind. He's not changing his mind at the moment, and he has fully supported Bob van Dijk and what Bob van Dijk is doing, and they're going along that path. It's a bit like Zuckerberg with his shares that he's got at Facebook, and so on. There's Google have got the same thing between Larry, Sergey, and Eric Schmidt. They control that company, so it's not unusual for tech stocks to be like that, to be controlled by the original founders, and those who bought into the company bought into it on the basis. But getting back to Naspers and Process, the discount on Naspers shares is higher than the discount on Process shares. I'm not going to say, well, a discount's a discount, I want to see full value. And asset managers are acting on behalf of other people, and they're fully entitled, and they're much smarter than I am when it comes to working out these, using Greek symbols and things to work out the numbers. I'm just going along the Buffett philosophy, and the Buffett philosophy says, if you can work it out, if it's obvious to you, Naspers is at a 50% discount to Tencent. Process is at a 30, call it odd, discount to Tencent. Well, if I can convert my shares that are discounted by 50% into shares that are discounted by 30%, well, then I'm a moron not to do it. That's the way I see it. Certainly, the asset managers say it's a bad deal, and they've got their reasons for it. But from where I sit as an individual shareholder, that's what we'll be doing. So we'll be converting our Naspers shares into Process shares at the opportunity.
Just on Discovery, Alec, Lee says Discovery is good buy now at 123, but is there potential for the share to go lower and perhaps wait before buying into it?
That's a little bit like my story with buying or selling Cloudflare, or finally getting into Cloudflare at 20 Rand. It needed a pandemic to be able to get Cloudflare in the 20s. I waited and waited and waited and waited and never got it. It was a similar thing with Netflix. Waited for a long time until it got to the right price. And it might. Discovery could go down, but there's the share price of Discovery. And I put in there the different waves as they started in South Africa, and we'll look at those in a moment. You can see the first wave, there was concern, but the share price didn't react too badly, and it quickly bounced back up. We were very lucky, by the way. We bought into Discovery in the 60s. So after that big crash on the pandemic's coming, it's going to kill us all kind of panic. Then the first wave, when that finally hit South Africa, there was concern, but it didn't fall back for very long. And then you had the second wave, which was much, much milder than had been anticipated. And the third wave, the anticipation here is that it's going to be worse, so far anyway, than what had been thought. So that's quite important when you look at those first, second, and third waves. If the third wave turns out to be less of a problem, in the same way as the second wave was here in South Africa, then you would expect that that share price would be going towards 160, 170 Rand a share, rather than back to 120 where it is at the moment. But there's so much media coverage on this. There's so much concern about the third wave that, and maybe it's because it's primarily hit the economic heartland of the country, that we have seen the share price of Discovery react accordingly. So what I did was I pulled out a couple of things on where we are with these various waves. And there's the new daily cases, and it can show you there that we're still going up. The 7-day moving average is going higher. Is it about to turn? Certainly in recent days, South Africa's daily new cases have been falling as a total. But some people will say, well, that's only because the Delta variant hasn't reached other provinces yet. It's only got to Gauteng. Who knows? Anything can happen there. But when I look at that graph, we're still below where the second wave is. And that's quite interesting when you consider what happened. So the second wave, if the third wave of COVID is not as bad as the second wave, then why would the share price have gone down when in the second wave it went up? Okay. And of course, all of this, why Discovery reacts so dramatically is because it's got the biggest health insurance in the country. It's got millions of members. And if the COVID wave is real bad, then Discovery is going to have to pay out lots of cash. But if you see that third wave starting to peak, maybe not. Well, we've got another week to go, supposedly, before it peaks. If it peaks below where the second wave peaked, that might change investor minds. But at the moment, Mr. Market's panicking. And then I pulled out this graph, which is very interesting, which shows the daily deaths. So Discovery is also a life insurance company. So if the daily deaths were to scream beyond where they were in the second wave, then clearly Discovery would be disadvantaged. But when you look at that, although this Delta variant has been more infectious than the previous variants, it isn't telling us, the graph isn't, and this is right up to date today, the graph isn't telling us that it's killing more people. So I know when you look at numbers, oh man, and you look at graphs, and it really doesn't affect, it doesn't tell the story of the heartache of individuals. But this is a graph that again suggests to me that there's at least a good chance that the third wave is not going to be as debilitating on the country in terms of mortalities. And it's also, although the deaths do lag, and if it's not the reporting, but the deaths do lag the new cases, but it is suggesting to us, if you overlay the graphs there, that the deaths, just look at that January, February, say early January to February, where the cases were, and you see that where the deaths were or the mortalities were much higher at that time. In other words, the lag is not that great. So put it all together. I mean, what do we know about this COVID? It's got us all confused. But if I go back to that graph there of the Discovery share price, to me, this looks overdone. When I have a look at those, the data, and the data, if it is overdone, if the share price is overdone, then this is a good buying opportunity. Sure. I hope I haven't offended anybody. And, you know, if you've lost people to COVID, you know, I know people who have lost very dear, close people, those close to them. That's not the intention. Here, what we're doing is we're having a look at the Discovery as an investment and whether or not Mr. Market has overreacted. And to me, it looks like he has.
Alec, just on Discovery, Gerhardus says, what about NHI and its effect on the Discovery share price?
You know, we worry about 80% of the stuff, or 80% of the stuff we worry about never happens. NHI is not just going to happen. It's not going to happen overnight. It's not going to happen very soon. And now that its champion has been exposed to have been a crook, surprising all of us who certainly bought the story that Zwelem Kizi was actually above board. You know, what next? What happens next? South Africa has to operate in the art of the possible. We have a country that hasn't got any money. It can't tax its citizens anymore. So how do you then implement something like national health insurance? Is someone going to give you the money to implement it? Are you going to raise VAT to 20% and further affect the economy, which is already on its knees? The art of the possible, or the art of rationality, suggests that the politicians will state their cases and they'll do what they need to do to stay in power. Will they kill the country along the road? Well, they can try, I suppose, but it's not possible to fund something if you haven't got money. And they've learned this from South African Airways, and they've learned this from Eskom. And the politicians are actually learning the hard way. Unfortunately, we're paying for it. That economics has got immutable laws. So, national health insurance, will it come in some form? Of course it will, because it'll be spun in that way. But will it come in at the basis where all of us are going to want to leave the country because we believe that we're happy to pay for our health? And my goodness, don't we all know more about or pay more attention to our health now than we did before? I don't know. I can't see it. I can't see the politicians committing suicide or economic suicide. And I suppose there's so much in flux at the moment politically in South Africa, and the next elections will give us a good indication of which way the country's going. But I always come back to the point that you have a lot of people who are shouting and are not crazy, and they'll take us. If they were to get into, if Malema got into power, he wouldn't mind taking us the Mugabe route or the Venezuela route, because that's what this guy really believes. He believes that you can destroy stuff and then it will be rebuilt at some time in future. But meantime, he's quite well protected by his own situation. Most people, though, are a lot more rational than that, and they realize that when you destroy something, it very rarely comes back in the same form. And South Africans, 80% of South Africa, 88%, I think, the IRR numbers, the data book comes out, are Christians or profess to be Christians. And that's a very conservative approach towards life. You know, treat others as you would like them to treat you, etc. And as a consequence of that, to see these people becoming extremely radical and destroying the country and spending money we don't have, which of course is impossible because no one gives you the money after a while, just doesn't make sense to me. So will the NHR come in some form? Yeah, sure, of course it will. Will it come in at a basis that's going to destroy a global company like Discovery? Unlikely.
Thanks, Alec.
Okay, so let's have a look at the Spotify trade. And you know this is a long-term portfolio. You know it's not about trading. But when we had that discussion in March and things were starting to look very heated, is it a bubble for emerging tech stocks, etc.? Spotify still aren't making money. So is it a bubble for them? You might remember we went into Spotify ages ago on the basis of the mushrooming of podcasts. We then sold them, Spotify there, as you can see, around about 250, 260 at a rand level of 14 rand 90. We then bought them back in at 14% lower, primarily because the rand had improved. Of course, the price of Spotify had gone down. And now Spotify is once again starting to recover. And as a consequence of that, and of course, the rand is falling, has been declining. It's from 13.85 now, as you know, around 14.40. So the impact of that has been quite extraordinary. And this is just emphasizing, I pulled these numbers out just to illustrate that you have to be aware that sometimes when the rand is overvalued, that is as good an opportunity when you have a largely internationally based portfolio as it is when you see that international markets are crashing or coming down. And look at this with Spotify. We sold in March at 252, and you can see there the rand was 14 rand 90. Bought back in May at 234, so almost $18 a share cheaper. However, on a rand, 1 rand versus the US dollar stronger. So the discount there was 14%. The share price is now $271, $272, and the rand is at 14.30, and the return on sale overall from March has been 34%. It's just a reminder that sometimes you get opportunities, and it goes back to that Discovery story there. When you look in March at the Discovery share price during the panic of the pandemic, the initial pandemic, and it got into the 60s, it halved in price. That was the time we bought, you'll recall, we bought Sasol at 28 rand a share. When these opportunities present themselves, although you are long-term investors, if you can keep your head when all around you are losing yours, you will get the opportunity to have a big swing at what Warren Buffett says, a fat pitch. Doesn't happen very often in a lifetime, but when it comes along, swing for all you're worth. And that's what we did at that time, you'll recall. What happened here with the rand going to 1380 and even stronger than that was it should have jolted and did jolt just about anybody who takes a long-term view on where South Africa is going relative to the rest of the world. And why the rand was so strong was because of commodity prices and the fact that Spotify, for instance, was at a really good level. So put it all together, and in a couple of months, you made 34% return. It happens. You get those opportunities, and it enhances the return on the portfolio long term. And there's the portfolio as it stands. Sorry, Stu.
Sorry, Alec, I came in a bit later. So just on Naspers, I know you'll probably touch on it now. John wants to know, what does one have to do to trigger the conversion to process, and when does it happen? Do you know anything on that?
Yeah, we'll cover that in detail. I'm not sure that we've been given final dates yet because there's quite a lot of debate going on. But we will certainly be communicating that through BizNews on exactly what needs to be done. It's usually quite simple. And in a case like this, I'm not sure how they're going to structure it, but they might structure on the basis that if you do nothing, then you convert automatically. Sometimes they do it that way, but I haven't seen the circular yet. I haven't had a chance to read it anyway. But as soon as it does, I will do the necessary and certainly communicate that.
Thanks, Alec.
Okay, and here's the portfolio. So there it is, the breakdown. Again, if you were a more of a short-term holder, you might have taken an opportunity of sold out of Amazon, Apple, even Microsoft. As you can see, they've performed extraordinarily well. But that's going against the long-term view that the world is changing, that the world is moving from an industrial age into an information age, and we are seeing that there are disproportionate winners and disproportionate losers. Because when you have these seismic shifts in society, in economies, then some companies will win. I mean, just think about it. If you go back 20 years and you said, oh, you've got this little website, or you've got a major newspaper, what would you value the one against the other? Back then, you might say, well, the newspaper's worth 100 times what the website's worth. Today, it would be quite a big difference because that website would have grown and the newspaper would have fallen. And instead of a ratio of 100 to 1, it might be 3 to 1 or 4 to 1, or even less. So that just lets you know how quickly things can change when you have this seismic adjustment as we have in society at the moment. So that's why we bought the shares we did in this portfolio going all the way back to December 2014, when we bought Amazon shares for $327. And as you can see today, they're $3,440. So it's just investing, not being tempted to sell, riding through any of the bumps that come through, knowing the stocks well enough to understand the value, or at least some kind of an understanding of your own intrinsic value of that share or of that company. And as long as it keeps growing exponentially, remember, this portfolio has gone from $200,000 to $740,000 in 6.5 years at a 20% growth rate. So Amazon grows at 20% plus every year. So you extrapolate that for Amazon, and your intrinsic value for Amazon would be considerably higher than where it is at the moment. And that's really the story of the portfolio and of the investments that we've made. Some of them have been sleepers, I hope, like 2U, which is up 4% in US dollars, thank goodness. And it's had quite a good month to get it there, but down 11% in rands. Why? Because when we bought it, at the period that we bought it, we paid up in rands. The rand was weak. On the other hand, Tongaat, I think we've articulated that. It is also maybe not surprising. We bought into Apple, and just to remind you, when you look back at Tongaat and you don't feel so clever about it, we bought into Apple. It's had a 5-for-1 split, so you could make that, I don't know, 100 and, well, it's 4-for-1 split. Sorry, $120 odd that we paid for it initially. And I was getting mixed up there with Tesla. Tesla had a 5-for-1 split. Apple had a 4-for-1 split. So Apple would be about $125, call it, when we bought in 2015. It went right down to $90. In fact, a little below $90 a share. So didn't look too clever for a while. But of course, today you look back and say, wow, just as well we didn't panic. And I'm feeling the same way about Tongaat at the moment. Doesn't look too clever right now. After buying at 10 Rand 40, it's 7 Rand 40. But the fundamental reasons for making that purchase are still intact.
Alec, you mentioned intrinsic value earlier. Dave just wanted to know, at some point, can you please share your research process and metrics? I know we did a portfolio, that webinar was one of the first ones we ever did in Houghton on intrinsic value. But
yeah, that's a good idea. In fact, we can easily share that webinar. Also, just buy my book, buy the Buffett book, get it off Amazon, and it's in there. There's a fair amount there on intrinsic value. Just very, very briefly, Buffett says, if a person comes through a door and you look at them, you don't need to know whether they're 310 pounds or 330 pounds to know they're fat. Intrinsic value is just to recognize if it's fat or thin. And you do that by working your own numbers out. Your numbers, that the value of any share, any company that you're buying into, is the discounted cash that you're going to earn from that, or that company is going to earn between now and doomsday, or the second coming, or whatever you believe, whenever you believe the end of the world is coming. So you could, if you're the teenager, you could take a 50-year, 60-year view on a company and then extrapolate those numbers. And of course, every company on the stock market, even Cloudflare, would be horribly cheap if you took it on a 50-year view. So what people do is they pull it back and they say, okay, well, how many years do you think we realistically can have this company operating in the basis that it's operating now? And that's why we have these exponential companies, because they are beneficiaries of a seismic shift, which would suggest that they would be able to continue to operate, be alive, be growing for 10 years plus, sometimes 20 years. So now if you make that view, if you make a view to yourself, you say, well, Amazon, I'm prepared to believe that Amazon are going to be around at least for the next 10 years. Then you take how much is Amazon going to generate in the next 10 years, and you then work out, you bring it back to today's value by using your own discounting view. You can take the what a lot of people use is the interest rate of the lowest interest rate in the system, because in other words, you can take your money, you can go and put it into US bonds, or South Africa's terms, into government bonds for 10 years. So a company's got a higher risk than that. So it's going to have to make more than that to make it a worthwhile investment. But you can use that, discount it back to today, and then you give yourself a figure that you believe. And that figure could be horribly wrong, but by having a figure there, at least you understand in your head why you believe that Amazon shares are worth $3,500 in your mind. And if the share price goes to $8,000, you need to look at your numbers and say, oh, no, it's too high. Or if the share price goes, and then you might be tempted to sell it at that point, or if the share price goes down to $1,000, like happened with Sasol, when Sasol went down to 28 Rand, and the intrinsic value we had was somewhere around 200 Rand, it was just ridiculously cheap, and that's why we bought in. So it's that discipline that you have an understanding for yourself, not anybody else. Doesn't matter what anybody else in the world thinks. It's what matters, that you understand your calculation. You have an intrinsic value. It's based on your own assessment of the growth rate of the company and how long it's going to continue or be able to grow for. And with Excel, it's so easy to work this out. Then you bring it back to today's price in rands or in US dollars, and you got yourself a number. But I think, Stu, it's probably a good idea to just put up that
Yeah, I've actually just found it, Alec. I've posted the YouTube link on the chat channel here for anyone who wants to have a look. But yeah, it was one of our first webinars, I think, in the Houghton
2016
location,
look at that.
2016. Yeah, so it's fantastic. Nice to have an archive easily available, I think, from the old days of library, Alec.
Yeah, it is. And I hope that when you watch that, everything that I've said today will be aligned to it. But it's of course, it's embracing complexity, but it's simple. It's simple stuff. Just get yourself a number that you know and you believe. And then if you think that the number has gone too high with an exponential share, sometimes it's easy to make that mistake. You can then have a value judgment, a value call on it, and maybe switch into something that offers better value. But for me, most of the times, again, the Obas from Omaha says the average time that you should own a share for is forever. So the only time that one would sell a share is if there's a fundamental change in the business of that company. And that's, to me, what happened with Facebook, with Cambridge Analytics, and even now with the antitrust. And it could be happening with Naspers now. But because it's trading at such a big discount, sure, it's very hard to sell today, and you know, tomorrow it could go up 30% just through one small action by the board of directors, and they're being pressured extensively by asset managers to do it.
But Dave just has a question on, he says, sorry, Alec, is there any reason why you're not holding a renewable energy company or stocks in that sector?
Not really. It's just outside my circle of competence. I think a lot of investing should be based on stuff you kind of feel comfortable, that you understand. I am a digital media guy. I mean, well, I'm a media guy. I've been in media my whole career, but I started in digital media in 1997. So as a consequence of that, I understand these companies better than renewable energy, which I do not understand at all. I guess if Chris Yelland was doing this portfolio, Chris would probably be saying, yeah, no, these are the best renewable energy, and this is the reason why, etc. To me, it's a huge learning curve to understand those better. And the point is, if you are going to have outperformance in an investment, you've got to start from the basis that you become a co-owner of the business. Now, you can only be a co-owner of a business that you understand, and many people will buy exchange-traded funds in renewable energy, for instance, because they see it as a big story. I can't do that because I don't understand renewable energy well enough to be able to see the profit that is going to be generated by a sector that is subject to Moore's law. And remember Moore's law, where you double the potential or the value of what you're delivering to the marketplace every year, and is at the same price. So where are the profit margins in something like that? That's the big question that one has to consider every time you go into a new sector. And in renewable energy, I don't know, maybe there is a gorilla, but in tech, when you're a gorilla, you get outsized returns. That's why I love Netflix. When it was below $500 after the financial results, lots of people were suggesting that Netflix needs to be sold. Now it's at 533. That's the investments, the right investments to make is go for the gorillas, go for the best companies in a particular sector, unless there is something that bothers you about that sector or about the way the people do business. And you can see this portfolio, it's structured along those lines.
Just on to you, Alec. Mike asks, if it is a sleeper, how long do you hold the share before you sell it or before you wait for it to move?
Well, Warren Buffett's suggestion is you hold it forever. If it's good enough to put hard-earned cash into, like a Tongaat, it's because you've done your research. I've been watching Tongaat for a long time. I like the managers. I like what they've done there. I also like the assets that they have in KwaZulu-Natal in the property sector. It's my home province, and I'm quite aware of the whole Umhlanga area and the tracts of land that are there, which might have been overvalued by the old Tongaat, but they certainly are valuable tracts of land. And the reason why Tongaat came into the portfolio after watching it for a long time was what was going on in Zimbabwe. And to me, there's still the two sides to the Zimbabwe story. My side is that eventually you hit rock bottom. The Zimbabwean people are very bright. They're very, very good at business if given a chance. And that is reflected by Zimplats, which is the most efficient platinum mine in the world, run 100% by Zimbabweans. So you've got a sleeping giant there waiting to go. And Tongaat's got a huge asset in Zimbabwe, in fact, two, Hippo and Triangle. So it does. When is it going to turn around? Well, hopefully in my lifetime. And I guess I just look at that and say the value is obvious if they get through this. And I think that's why some very smart people have been selling the shares, because they're saying maybe Tongaat won't get through this. Maybe the debt, maybe the banks are going to play hardball, and maybe they're going to put them into liquidation, whatever. To me, the underlying assets are just so strong that shareholders are covered by those assets on the debt that they're sitting with. And you've got a very good management team, and that Zimbabwean asset, if that comes to account, well, then the share price, then you will get the exponential growth in that share price, which is really what we look at all the time.
Pritesh wants to touch on, I know it's big in the news, Alec, with AfriCrypt and the Kaji brothers missing, but he just wants to know when we're going to start looking at blockchain currencies.
Okay. Well, my history on that goes back a while to Dr. Doom, Nurul Robini. I watched Robini stand on his own while the rest of the world ahead of the global financial crisis was saying happy days are going to continue indefinitely. And Robini said, watch out, watch out, watch out. And he was laughed at. I sat in a relatively small room in Davos where there were 4 economists. One of them was him, and they were chuckling at him. This guy, really. And he was right, and they were wrong. And Rubini has been saying from the outset that cryptocurrencies are a scam. So that's the first point. The second point is I was at a conference in London in 2019, just before we'd finished our 3-year term in the UK, where the head of investigations at the IRS and the head of investigations at the counterpart, the HMRC, were giving a presentation. It was one of David Marchant's offshore alert conferences, very, very well supported by top people in that field. And they explained that 90% of the turnover in cryptocurrency is through criminal syndicates. It's through the underworld. And it makes a lot of sense if you think about it, that if you are dealing in money that you don't want to trace because the banking system is now so highly regulated that you can't take the cash you make on illicit cigarettes, yeah, hello South Africa, or illicit booze, yep, which is going to happen now with the prohibition. How do you turn that into usable asset? Well, cryptocurrency is untraceable, and the IRS and the HMRC, which is its equivalent in the UK, was saying that it shouldn't surprise anybody that that's where the crime is. That's what the criminals are using, and we forget about this. We carry on in our lovely worlds and forget that there is a parallel universe to the real economy that we operate in, which is the illicit economy. And if you're interested in things like that, there's actually a book called Illicit that I would strongly recommend that you read. I met the author and he explained the whole thing to me. And Barry Sargent, my late friend, was very, very strong on this. Anyway, so if you're in the illicit economy and you want to launder money, how do you launder money? HSBC aren't going to open their doors anymore. You know, they got whacked enough time, enough big fines that they've had from the Guptas and so on, through the Guptas and so on. So how do you do it? Well, crypto is untraceable. Makes sense. And hence these youngsters, these Kaji guys, where are they? Are they alive even? Because when you're dealing with people in the underworld and you cross them, well, it's the reality is that, you know, your life expectancy is not very high. So that's what I feel about that whole system at the moment. There are far, far smarter guys than me who are making lots of money out of cryptocurrency. The way I would look at it is the Federal Reserve has already issued its notice that it is going to have a crypto dollar. It's going to have go and have a look on the Federal Reserve website, and you will see that there is the first and only video done by the chairman where he explains what they're going to be doing about cryptocurrency. And they're going to have a crypto dollar, which will be convertible, and it'll come in 2023. Now, when you have that, why do you need a Bitcoin? Maybe I don't know what I'm talking about, but that's just in the way that I look at the world. Even our own South African Reserve Bank is looking at this for good reason, because if people can move cash around, why would they bother to pay taxes? Why would they declare anything? And if you aren't going to declare things, then the whole system, if there's no taxes, the system collapses. So they've got to do something about it, and they've got to be able to either trace the existing cryptos or invent their own. And it seems as though central banks are doing the latter.
Excellent, thanks, Alec. Andrew just wants to know what happened to Zero. It didn't seem to last long. I'm not sure if we missed it or.
No, we got it. Oh my word! It isn't in this table. No, Zero's actually done quite well. There it is. My apologies.
Sorry.
It's about halfway through. No, Zero's a 5% of the portfolio. It's doing great, by the way. It's up now 6% in rand terms, and 6% in dollar terms. So I think it's trading at about $135 Aussie dollars, which is $104 US. Yeah, it's great. The financial results came out, which had been anticipated to be much better. Again, Mr. Market getting all excited about it. They knocked the share price down from 140 odd Aussie dollars all the way down to below 100 Aussie dollars, and now it's back to 135 Aussie dollars. So Zero is a phenomenal company. We use it at BizNews. Anybody who uses Zero will know that this is something that is a league ahead of anything else in the online accounting area. It's integrated now with SARS here in South Africa, with banks in South Africa, and we're just one small part of a global story. They've dominated the Australian and New Zealand markets. They're from New Zealand, and they're moving into the US and the UK, and those are the big markets. And here in South Africa, they've done extremely well. No, Xero's, don't panic if you own it. It's one of those that you just put that in the bottom drawer and wake up one day and you'll be very happy.
Thanks, Alec. I see the hour's almost up to come to an end, but this is a good one to finish on, I think, Alec, from Howard. He says, if you had some more money to add to your portfolio, which 2 stocks would you put it into, or would you spread it out amongst the whole portfolio?
Yeah, that's a great question. When the Rand was below 14, the temptation was to try and take advantage of it. You might recall at the time, I really, really scratched my head about Naspers. And with hindsight, it would have been a smart call to have sold Naspers there. But who knows? Maybe tomorrow they change their minds and it goes up 30%. So Naspers, it's horrible because once you're in, because it's at such a big discount. And that's a good lesson. It's a good lesson for the future as well. That don't go and buy something at a deep discount because it might stay at a deep discount indefinitely. Of the individual stocks that I like the most on the portfolio that you look at here, of course, Tongaat, down by more than a quarter from the price that we bought it at, is very appealing. But on the other hand, it's also high risk. That's why it's only 3% of the portfolio. But if I came into some money today and was wondering where to put it, I would probably go into the top 2, Amazon and Apple, top 2 holdings, and then Netflix and Spotify, and Xero actually. Although right now, Discovery has got to be standing out with it like a bit like a sore thumb, hasn't it? At 123 Rand a share. So, but you never know. You know, when you try and trade like that, and you try and buy into stocks that seem to be cheaper today, they've got a horrible tendency of making you look like an idiot. And I've been looked like an idiot in more times than I'd care to admit to. So those would be, if I suppose, if I'm starting a new portfolio, and that's probably the big question for us when we come to the 7th anniversary in December, is to liquidate this portfolio and start a brand new one again. Because a lot of people will be saying, would you really put 23% of your portfolio into Amazon? And the answer is yes. Would you really put 20% into Apple? Yes. Would you put 10% into Microsoft? Maybe not that much. Would you put 8% into Naspers? Definitely not. Would you put 7% into Netflix? For sure. And Discovery and so on. And you could go through the whole portfolio in that way. But maybe we should be doing that, and probably will be doing that in December, reworking the portfolio, starting again from scratch, and again taking a longer term view on those. So I hope that answers the question well enough. If you are sitting on a chunk of cash, remember that more than 40% of this portfolio is invested in Amazon and Apple, and I'd be happy to have 40% of any new cash that came into those 2 stocks today.
Excellent, thanks. I had a chat with my brother. He says we're all looking for the new Amazon and Apple, but those 2 just continually perform. So just stick with them.
Well, remember that thing when we started off the conversation before we came on air, we were talking about Howard Marks, and you mentioned it. When Howard Marks he learned from his son during the pandemic. His son moved in with him for the family to be, his son's family moved in with him. And he said it was fantastic because they never really had the opportunity, his son's also a money manager, to sit and talk about this passion that they share for investing. And he said after some weeks of engaging with his son, he realized that the reason why his old philosophy of just value investing didn't hold true anymore is because the world had changed. And his son has convinced him that when you buy into these exponential companies, i.e. companies that grow 20% plus, you will always kick yourself when you sell them, because although they might look to have been overvalued in a short period of time, when you take that long exponential run into account, and remember, the only thing I have to urge you to remember is in 6 years, 6.5 years, you've gone from $200,000 to $740,000, growing at 20%. That's what exponentiality is all about. It goes so quickly if you can just add to it and don't lose. And that's the main thing. Buy what you understand, stick with it, and in the long term, you just resist the temptation to sell because it's gone up dramatically in the short term. My final comment, would we sell Spotify today because we made 34% in 2 months? Most definitely not.
Oh, thanks, Alec. I think we leave it there on that one. It's a nice note. And as always, the next portfolio is the last Tuesday of every month. So I think it's the 27th of July, Alec, at 12 o'clock. But we'll send out reminders as I think we missed this one. It was a bit late, but we'll send them out a week or two before next time, Alec.
Indeed, we will. And from Stuart Lohman and myself, Alec Hogg, it's been our pleasure to be with you. Don't forget, by the way, guys, to go onto biznewsradio.com. We do have our Business Power Hour there every night, 5:30, 7 o'clock, and then 7 in the morning. And the rest of the day, we play music that is smooth music, but maybe the soundtrack of your life. We like to put it that way because it's like, songs that'll spark memories. Anyway, please go to biznewsradio.com. Go and have a look at it. It's a streaming service, and I promise you, once you've tasted it, you're going to be back for more. But from Stu and I, till the next time, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.